Good evening, everyone. So we're going to be on our third video, and this will be the last video because we did the calculation already as we showed through you, right? So when you go to your quiz, um, you should be able to actually see how the calculation works because it's almost the same format, and it's an easy quiz for the week. So now we're done with the income statement. So our next one is the cash budget. When you think about cash, it's actually the in and then the out, right? What's the in? It's the cash receipts from the sale of basically the collection of the credit sales of the items that you sold. So wheels and then caster 3,000, and the items that we need to sell about 100,000 for the year June 2022. And then, of course, we would actually collect it. And then what are the expenses? The expenses will be the cost of goods sold, the operating expenses, and then the difference would be your cash balance. Now, we we are assuming when we go to the next slide that there is a minimum cash balance of 5,000 per month. So we're gonna incorporate that in our analysis as well. I'm going to go to the next slide before we go to the Excel file. So we have here the monthly sales pattern. So remember, we're always saying June 2022, right? Because only from January all the way to June. So these are actually the sale of the item. When you add everything up, it's actually 100,000. So remember what's 100,000? 100,000 is actually our um revenue for the year, right? So when you add it all up, it's 100,000. Just something to remember. Now, on the cash receipts, there is a there's always an assumption that you would need to understand, right? How is the cash receipts being calculated, or what's the assumption? So, in our Goldman Corporation example, 20% of the sales collected in the month of sales. Oh, 20% of sales collected in the month of sales, and about 80% collected in the following month. So what happens? If I make a sale of $1,000 this month, the month of say September. So in the same month of September, only 20% or $200 of that 1,000 is actually recorded as cash. And then what about the 80% or the 800? So next month, when it comes October, the company is able to collect 80% of the prior month sales. So in October, 80% of the 1,000, which was sold in the month of September, will be collected in the month after, which is actually October, right? So basically, it happens because you are looking at. So why do we need to do this? You are looking at um, a calculation or an assumption of collectability. What's the cash collection flow? And then now it's 20 current, 80 the month after. Okay, so just want those are important to note as well. Now, we're gonna go now through this cash receipt cycle. It will be best if we actually go back to our Excel file so I can show you the formula. So when you go to your exercises, you can see it as well. Let me switch. I'm gonna move it out and then I'm gonna have it here. So we are now back and then we are now focusing on the cash receipts, this section. So here, I'm gonna be making sure. So we have December of 12,000, which is actually the prior year, right? So remember, this is 2021, and then the rest here are actually 2022. So just want to make sure we remember that, right? But for now, I'll carry it out. So 15 to June, let me just make sure that we add. If we add across, it's actually 100,000, okay? Up to here, because that actually ties up with our sales of 100,000 here. So it does tie up. So this is a connected problem. So what we're saying is that 20% of the current month sales, say January, is actually collected on the month. That's why we will just multiply here. Easy, right? And then 80% of the prior month is collected in the current month. So that's why December exists here. So if I take this out as a formula, just taking it out, I will do it this way. 15,000, which is the January sales, multiplied by 20%. Now I need to make sure it carries over, right? What is constant? The 20%. And then 20% is I-26. What do I mean? That's actually cell I-26, right? Because it would actually be changing from one, I want it to be constant from one column to another. And then um while January 15, or not January 15, January would actually be moving. So what I can do is that I can make sure I pressed F4 to do an absolute value. So basically now it actually moves as you go through, right? So here, 80% multiplied by prior month, and making sure that I actually do a absolute value on the 80%, and then it goes down. And then it should be the same also, right? I can do the same thing if I don't have the dollar here. I highlight the whole thing. I'm pressing shift and then the arrow keys to highlight it. Alt equals, then you have the same dollar number. Okay. So 12,000, 14,000, 11, 17, 23, or 16,000. I'm gonna move it here so you can see on our file, the PowerPoint is the same, right? Now, basically, that's the cash receipts forecast, the first one. So as of June, there is actually a cash receipt of 16. But does it mean that this is the cash balance in the balance sheet? Not really. That's the incoming cash. So what is the cash balance? I need to consider the cash outflow, the payment. So that's why I need now to include a cost of the production and the operating expenses. So what happened on the problem is that, remember we have two products, wheels and then casters, and then each one has the unit cost, the one that we produce, right? I'm linking it here with 10, 5, and 3. It's 10, 5, and 3. You might not see the 10 right now. Let me escape from that one. 10, 5, and then 3. You can see it's actually through here, right? And then we're just basically linking it out. Casters, 12, 6, and 4, materials, labor, and overhead. I'm highlighting it here also. It's linked. I'm going to go press F2, and you can see that. The quantity is the quantity that I would actually produce for wheels and then casters, 2020, and then 1015, 1015, and then 2020, 2020. So it's basically a multiplication between the unit cost and then the quantity, and then that you will come up with the production cost, which is actually this one. So I'm going to show you, and then it's a total. And then now what's the total now? I'm combining both the wheels and casters. If I combine it, basically the column or the cell for wheel on materials, and then casters for materials, and then labor, and then overhead, then that would be the cost for the period ended June 2022. So that's 6 months. So what I do is that on a monthly basis, remember we're doing monthly. How can we tell? Because our cash receipts is monthly. So I need to make sure that I can do this also on a monthly basis on the cash outflow or the cash payment. So accounting and finance is always making sure that you have unitized data, unitized data that are similar to each other, so you can actually compare. So I'll delete. So now I have a monthly. So that's why I highlighted in light blue. I'm gonna go down, okay? So my material purchase is actually here, which is basically this, the 5,732. Let me delete that. Let me change. So basically it's there, it's just linked, right? We just carried it over. And then now we have an assumption also that what you purchased in the current month is paid the month after. That's part of the problem, right? What do I mean? What you plan to purchase for the current month of January is actually paid the month after. You would tell me, sir, how would you know? Because it's the same 5,000, right? It's because of the December. Let me make sure we highlight that properly. The December 2021, it's paid in January 2022. So it carries over. So that's why the linking. So these are assumptions. Normally, the assumptions will be spelled out for you. These are the assumptions and how it looks. And then the June one. Sorry, guys. And then now the monthly for labor and overhead, as you pay it, you incur it. As you incur it, you pay it on the same month. That's why it's just pulling out. There's no flow or scheduling compared to the materials purchase. So these items are captured. I'm going to highlight it. So you can see it. Oh, okay, let me just like use the same color. And then the other items right now are items on the income statement. For example, this general and admin expenses of 12,000, that's a given. That's coming from our income statement a while ago. Let's go back there. Let me just move it out around. Remember this 12,000 general admin expenses for 6 months. Basically, I just divided by 12, same as on the PowerPoint. That's the reason why it came into fruition, right? So it's 12,000 divided by 6, and then you spread it across. And then the rest are given. So basically, include the equipment purchase and the dividends. So equipment purchase is capital expenditure for the company, and then that's still a cash outlay, right? So that's why you just need to add it up. So don't forget, you are not adding up this layer here because it's the scheduling of when you incur it, when you're going to pay it, right? So that's why it's only from the carried over the balance, and then you just basically add it all up to get your cash forecast or cash payment forecast. Now, in the problem, which I'm going to move so you can see it, and I'm going to make it big. Kindly hold, guys. It's going to change. I need to change the setting. I use two screens, that's why, okay? So it's the same as what we did. We just want to make sure we show it. We simplified this or we expanded this one. Remember that 5,732, 2866, and 1854. We just expanded it. So what happens now is that there's an assumption. The assumption on the problem is that the company, I have a lag, that's why it's doing that. The company wants to maintain a minimum cash balance of 5,000 at any period of time. If it's February, it's going to be 5,000. If it's March, it's always going to be 5,000. That's your ending cash balance. It's a given. But you need to know both on the cash inflow and outflow. So this is the net. So the net cash flow is basically cash receipts minus cash um, payments. Let's make sure that we can zone into a number. Negative 11,955 here is because it came from, let me go up, okay? It came from the total cash receipts, which we have also in the Excel one, and then the total minus the cash outflow or the cash payments. That's why 16, then deduct 27,955, which is the cash outflow for or cash payments for June, equals the 11,955. I will do a quick one on our slide as well, on our file. Remember this. I'm going to do this one. Cash receipts minus cash payments is basically, I'm just going to highlight it like really light so you can see it. So net cash. Okay, so it's the same. I just I had it in Excel so you can see it now. So total cash receipts, I just basically pulled it up from our original schedule. And then the total cash payments deducted, which is actually our cash payment forecast. And then that's the net cash flow. And then now you have negative 11,955 in June. Also, we have issues. So what are the issues that we have? I'm going to highlight it, issue here, and then issue here. So what is the rule? I need to maintain a $5,000 per month balance. And then if we need to actually loan, we need to make a loan to maintain that 5,000. That's the rule. That's actually what is the problem asking. And then if we have excess money in excess of the minimum cash balance of 5,000 per month, I can use that money to make a payment of any loans that I have received. So how do we do that? So in order for us to actually work on it, beginning balance, I'm gonna go back to the Excel file, and then I'll send you this the Word doc or the PowerPoint, and then we will send you the Excel file because sometimes it might be a format that's needed in the problem. So I want to make sure that you can actually see it. But the Excel file, I'll send it to you so you can actually take a look on the formula. Okay, I'm going to change colors here. So we have a problem on certain months. We flagged it that there are certain months that you actually have a negative balance, right? So what's the cumulative balance? Here's your net cash flow. You have a beginning of 5,000 of cash. So you have a cumulative balance of 6,380. You just basically add across. Now, the cumulative balance as of January, you don't, did you meet the 5,000? Yes, you met the 5,000 because it's actually higher than 5,000. And then you don't have anything to pay as a loan, nothing, because you did not, the problem did not say that you have a loan balance. That's why you're actually good here. So when you start the February, you have a net cash of 6,552. You have a carryover. Let me make sure that we change the color for the carryover. Kindly hold guys. A carryover from January of 6,380. When you add across, it's negative. Remember, how much do you need is as a cash balance? You need always a 5,000. So how do you do make, how can you make a 5,000 cash balance? I need to loan. How much do you need to loan? I need to loan 5,072. Why? If it's 5,072, what will happen now is that I can cross out the 72 negative here with the $72 excess. So it's now going to be 5,000, right? So that's actually how we were looking at it. Now, Next month, which is actually now March, I carry over the 5,000. I have now 1,095. Is 1,045 equal to 5,000 as a cash balance? No, it's not. So I need to make another loan. So this is the secondary loan. First loan, 5,072. Let me clear that out. So it's a bit clean, right? The second loan, just do this one. Kindly hold, guys, okay? Okay. The first loan, 5,072. The second loan is actually 3,955. In order for you to make 5,000. So what happens now? 1,045 plus 3,955, you would actually have now a 5,000 balance, right? So you basically carry this over again, and then your net cash flow for April is 5,000, 4,548 plus the 5,000, you have 9,548. You now have way enough cash. You have enough cash. By how much? The difference between this one, the 9,548, and then the 4,458 is 5,000. So how did we do that? Basically, this amount is extra, wherein you can make a payment to the two loans that you have because you only need to keep 5,000. So you might have noticed that I'm skipping the cumulative loan balance because the cumulative loan balance here in this section, let me make sure I highlight it, it's just basically adding 5,072 plus 3,955 equals 9,027 minus what you actually made as payment is 4,479. So that's why this one I'm trying to avoid, but it's basically a schedule for math, but I don't want to taint it on how you compute directionally and logically the 5,000 requirement. So nothing too crazy. It's just the way things are being presented in Excel, right? And I'll go back to or on the PowerPoint. I'll go back to Excel. So same, you still have 5,000 that you carry over. You have the movement of May. You have 15, but you only need. So if I add here, if I have 5,000 all the way to the deduction of the payment of 4,548 in the month of April, so 5,072 loan in Feb plus the loan in March minus the payment in April, you would actually have a balance of 4,479. That's why it's called cumulative loan balance. So I have 15,000 right now. So I can actually pay that 4,000 and liquidate it. So here's my cash balance without any outstanding loan and still more than 5,000. So it's good. So I carried over again here in the month of June. But now my movement in June is negative 11,955. So I have a 886 deficit or a negative cash. So I need to keep 5,000 balance. So I would borrow $5,000 above the 886. So this 5,886. You don't, that's your new loan. So basically, this will be your cash balance. So if somebody asks you, what's the cash balance as of June 30, 2022? It's basically 5,000 because you would always have 5,000. But as you go through each month, you actually have a different cash forecast. So why is it important to do it this way? You need to know when are you going to take a loan. So basically, the reason why we're trying to understand this and breaking it down by month Like all this work for what? It's because we wanted to make sure we understand and forecast, hey, we need to call the bank, we will take a loan here. Okay, let me just make sure. We will take three loans or two loans. Actually, we will take three loans in the year 2022. Those are the instances. And then we will be able to pay the two loans in two installments to make it zero, but we will take a new loan in the 6th month, right? So if you have this forecast, you can now know what is the use of your capital, the use of your resource, or even forecasting and talking to your bank. Now, I'm gonna go in and then use the Excel file. I kind of modified the Excel just to show some or just to highlight some schedule or like details. So cash receipts minus cash payments, we know the cash flow. We remember that 11,995. And then this time around, what we did was I would add the beginning balance here, 5,000, that's from December, right? And then you would see the 72 here, the cumulative cash balance, which is basically, let me go in edit mode. I will just basically add that. And then how do I know that I need to make a loan? Basically, I would always use a 5,000 as a balance. And then I'm just doing a formula in between to just calculate. So it's the same logic, it's just an easier Excel file explanation or easier schedule. You can do some if functions. It can be more complicated if you don't follow the rules or if you make a incorrect formula. But for now, you can do it by logic, right? Now, after that one, you should be able now to calculate basically the balance sheet. So how do we know? Let me make this balance sheet a bit bigger. This one's coming from the PowerPoint slide. 5,000 would always be your cash. 16,000 of receivables is basically, how did we get 16,000 of receivables? That's actually your receivable that you have outstanding as of June 30, 2022. What about your, oh, sorry, I moved the schedules. What about your inventory of 6,200? 6,200 is actually your ending inventory based on the schedule. And then the rest are actually given, right? Um, Actually, some of them are on tables, but those were actually given on the tables. And then accounts payable, 5,732 are your schedule of payments and what. So basically you have completed a balance sheet, right? Now, I'll go to the next tab, which is the alternative. I'm just gonna try to make sure it's easier. We start off first with the income statement. The income statement here is what we have calculated. Let's make sure that we check it. I'm gonna go control page up. In my keyboard, 18,524, 18,524 increase in retained earnings. Control page down is the same number. Okay. Now, what I did was I wanted to see what's the percentage, like a common size ratio. If sales will be constant, and then everything in the income statement will be expressed as a percentage of sale, how does it look like? So it looks like this. And then how is it? So basically 61,470 of cost of goods sold divided by the revenue, right? So basically we have that formula. Each item in the income statement is expressed as a percentage of sales. And then let's do it this way. Sometimes the easiest way to forecast, I'll just show you an alternative, right? I know we have a full calculation that we did, but I'll show you one alternative. somebody would say, if this is a yearly one, it can be monthly, it can be any period of time, it can be quarterly. So just be mindful of the period of time. I'm gonna now do a forecast in 2023. And then I'm hoping my base case, we talked about base case, worst case, and then best case, there will be a 10% increase in sales or revenue. For now, I'm going to use the dollar amount because it can be an increase in quantity or an increase in unit price. But for now, I'll do a dollar amount. So if there's an increase in by 10%, I will do 1.10 or 110%. So that will now be my new revenue in 2023 if I'm forecasting it. I know that about 61% of the cost of goods of sales is cost of goods sold. I can simply multiply it this way, right? So basically, I'm going to be using now the percentage here to express the items in the 2023 forecast. It can be as easy as that. So if this will be held constant, let me just try, guys, something, right? I would only use not an absolute reference, but after F, there you go. And then I'm gonna take out the dollar amount. So it will be now. So I just use a after, so before or after the letter F, which is F36. You can see it this way. If you put a dollar sign on both in between F, so dollar F um, dollar F dollar sign then 36, it means that it would always be an absolute reference, right? But if I put dollar F, that's your first block, then it will be on the rows. But if I put no dollar, then F, then dollar sign, and then you're locking it based on the rows. So if I copy it, it will follow and change the rows. So basically that's your Excel rule, right? Which is actually something that I need to actually move by one. Sorry, guys. There we go. That's why I always try to make sure I actually do it by eye. There you go. So this is correct. Because now it's expressed in sales, but I need to make sure I have it the sales slot. So let me make sure I have that. There you go. So everything now is based on a percentage of sales using the percentage or the common size in 2022 but I just included a increase by 10% in the sales in the sales amount, which is actually from 100,000 to 110,000. Then everything else I kept the same. Of course, somebody might argue that you might need inflation or whatnot, but for now, it's a quick way of doing an analysis. Highlight the whole thing, format painter, copy the whole thing. So at least I have the same format, and that's your forecast. Now, what about the balance sheet? Another way, so what are the hardest thing to forecast in the balance sheet? Accounts receivable, inventory, and then accounts payable. Because it's actually, you need to create a full schedule, right? Like how we went through um, today, this week's exercise. So remember this one from Harvard Business School, like the one that we used on week number 2. We talked about the formula of the DSO, the DIO, days inventory outstanding, in our case, days sales out inventory, and then DPO, days payable outstanding. So I took the same information. I wanted to make sure that you can see it as a reference. And then here, these are the formula. These are the things that we were looking at. It's the same as what we have on the screenshot from the um, HBS slide or picture. Now, what is missing is actually the balance sheet accounts, right? I have the DSO formula, but this is the one I want to forecast. Because why? Revenue, I have it. It's down below. Oh, here. I'll just say we're doing 2023. Cost of sales, I have it here. And then operating expenses, well, I have it there on the bottom, right? So it's easier. We're now doing 2023 for balance sheet. So how do we do that? We just basically do a reverse of the formula. AR now is actually revenue divided by 360. I'll just use 360 for now. So you converted the the forecasted revenue in the number of the annual revenue in the number of 360 days, then multiply by your desired day sales outstanding. And then your cost of sales, make it daily, multiplied by your desired number of inventory outstanding, days inventory outstanding, and then days payable outstanding. So I highlighted here, if I think for next year, it will take 45 days to collect receivables. If I think inventory will move every 30 days, if I think that my estimate or assumption is that payables will move in 40 days, or I would make a payment every 40 days, then let me do the recalculation. So now I have my revenue divided by 360 and then multiplied by 45 is the accounts receivable. So this is now basically AR. Let me just highlight it. And then now this will be inventory. And then this one will be your accounts payable. And then how we did it was, I just want to make sure that it's actually a dollar amount. Here, dollar here, just proper formatting. Is by dividing it by 360, then multiply it by 30. So that's basically the annualized one. I just realized, class, that we have June, right? 6 months. So for now, for sake of argument, I'm using 360, but because it's the entire year, just wanted to flag it there. So when you do your forecast, if you have it in the full 2023, I will just basically link the calculation of AR, inventory, and then accounts payable. And then the rest might be given. So I'm just showing you this one as the practical alternative calculation. In the exam or in the quiz that will be given, we will be using the long method, right? But if you're doing, say, a capstone project, if you're doing a quick forecast for when you do work, and then you're doing quick forecast, you can use that as alternative. So we use this in practice. I use this in our quick analysis if I need to create a business segment balance sheet rather than a full month over month, right? Because that can take a while. So I wanted to show you a alternative. That's why I mark it as alternative on a balance sheet and then an income statement forecasting. So that ends this week's video. I do hope you actually picked up. I know it's a long calculation, but we want to make sure that you know where are things going to be linked, or where's it coming from, and then things that are uh, things that are the technical side on how we do it on a full calculation from income statement to cash balance to balance sheet.